Good morning and welcome to the Killik & Co market update. It's been a good week for markets with new record highs for the MSCI World Index, the S&P 500 and the Nasdaq Composite. Here's the S&P 500 over the last 5 years. It's currently trading at over 6,500. Part of the reason for the market strength is the anticipation that the US will cut interest rates next week. Here's what the CME FedWatch tool is showing us at the moment. This is a live tracker that shows where market participants expect the US interest rate to be after the next Federal Reserve meeting. The current rate is 425 to 450 basis points, or 4.25 to 4.5%. 7.3% of investors think the rate will be 375 to 400 basis points after the next meeting, which would mean a cut of 0.5%. The rest expect a cut of 0.25%, and so 100% of participants expect there to be a cut of some sort. Part of the reason for the expected cut is some recent weak labour market data from the US, which does suggest the economy does need a bit of support. Here's the non-farm payrolls data for the US, showing the number of new jobs created within the economy on a monthly basis over the last 3 years. The trend is largely heading downwards, and the most recent figure for August was particularly disappointing, with just 22,000 new jobs being created. The thing that would prevent the Federal Reserve from cutting interest rates would be high inflation. But we had the latest inflation data for the US this week, and the number came in at 2.9%, a little bit higher than the previous month, but lower than people expected it to be given all the tariffs that have been imposed. So therefore, the publication of the latest inflation data did not dampen the expectations of a rate cut next week. Shares in Oracle have been in the spotlight this week after gaining 36% in a single day when the company published a good set of quarterly results. The net worth of the founder, Larry Ellison, grew by $100 billion in a single day, and he briefly became the richest man in the world before the share price declined a bit towards the end of the day's trading. Oracle is a technology company that provides both hardware and software to businesses. For much of the last decade, it has been considered to have been a bit slow to have jumped on the AI trend. Here are Oracle shares against the S&P 500 over the last 10 years. They tracked it very closely up until 2023, whereas many other technology firms such as Microsoft and Nvidia significantly outperformed it. But you can see that Oracle has moved ahead of the index in the last couple of years, particularly during this year to date. The reason for the excitement has been the growth in the company's cloud infrastructure business, which supports AI. Here's the key quote from this week's results. "It was an astonishing quarter, and demand for Oracle Cloud Infrastructure continues to build. Over the next few months, we expect to sign up several additional multi-billion-dollar customers, and RPO is essentially contracted revenue, is likely to exceed $500 billion. The scale of our recent RPO growth enables us to make a large upward revision to the cloud infrastructure portion of Oracle's overall financial plan, which we will be presenting in detail next month at the financial analyst meeting. As a bit of a preview, we expect Oracle Cloud Infrastructure revenue to grow 77% to $18 billion this fiscal year, and then increase to $32 billion, $73 billion, $114 billion, and $144 billion over the subsequent 4 years. And lastly, US pharmaceutical giant Merck has cancelled a £1 billion expansion into its research capabilities in the UK. And this is despite the fact that the company had already started building. The company has blamed the UK government and said that the UK is no longer a competitive place to invest. There has been a worrying trend of falling foreign direct investment into the UK in recent years. Here's a chart showing net inflows of foreign direct investment into the UK. There was a big spike in 2016 for a couple of reasons. One was the takeover of Arm Holdings, which was previously listed in the UK by SoftBank, and the takeover of SABMiller by AB InBev. But aside from those, the trend is generally negative. The comments from Merck feel very similar to the comments made by AstraZeneca recently when the company cancelled its new vaccines facility in the UK. It's a shame to see big global companies like this speaking unfavourably about the UK economy, and AstraZeneca in particular is considered to be a UK success story. The shares trade in London and have risen from just over £40 to £120 in 10 years, so it would be great to see companies like this investing more in the UK. Moving on to have a look at next week, it's looking very quiet on our corporate calendar, with no companies on the Killik covered list scheduled to report, but we have got the Federal Reserve rate decision expected out on the 17th. That's it from us. Have a great weekend, and we'll see you next Friday.